Hello and welcome everyone to this month's monthly market update for February 2023. My name is Steve Latham and I'm the Chief Investment Officer for Bernicke Wealth Management. And today we just want to go over a few topics with you, focusing specifically on inflation and the Federal Reserve and the monetary policy that they're using to try to combat that inflation. So to start the year, we have seen inflation continue to moderate off of its peak from the second half of last year. It's a good sign. A lot of where that inflation is coming down is within the goods sector of our economy, basically used car prices, any equipment, things that you purchase at a discretionary basis within your home. The costs of those have gone down quite precipitously and are near or at levels, depending on what item you're looking at, that we saw prior to the pandemic. So that's where a lot of the disinflation is coming from within the economy. The other side of that is on the services side, and we are still seeing inflation at least maintain its level, maybe depreciate a little bit, but not nearly at the clip that we'd like to see to get that back to pre-pandemic levels. And so as we look ahead into 2023, we do feel as though inflation will continue to moderate throughout the year, albeit it'll probably be at a more choppy pace where you could see some months inflation increase slightly. But generally speaking, we do believe that trend is going to be lower, and that's what the Federal Reserve is going to be focusing on as well. In their meeting last week, Jerome Powell, the chair of the Federal Reserve, did acknowledge that inflation was coming down, and that's what they wanted to see as well. But there are other things that they're looking at in order to adjust their overnight policy rate. And speaking of that policy rate, they did increase the overnight rate by 0.25%. Making the high end of the range for what that rate looks like to be 4.75%. Now, they did acknowledge that they will likely continue to increase rates to combat that inflation. Right now, depending on the gauge you're looking at, like in the prior chart, it was anywhere between 5 and 6%. Their long run average, they want to see that inflation get down closer to 2%. And so they still believe that they have a lot of work to do. And what they're going to be starting to message here is not how high that overnight rate is going to get, but for how long they're going to keep it there. And the reason why we show this historical perspective of interest rates going back to the early 90s is when the Federal Reserve increases rates, they tend not to keep them at that elevated level for too long. And so that's what Jerome Powell and the rest of the Federal Reserve is going to be messaging against, is they want to keep them high, to keep policy restrictive in the hopes that inflation continues to moderate. Right now, the market is actually arguing against that because it's forecasting that we're going to see interest rate cuts towards the end of 2023. Now, we think that's relatively unlikely, but it's certainly a possibility. We do think that currently interest rates will start to get cut in 2024 at some point in time. But that's always going to be dependent upon inflation and where we see that inflation get sticky or stay elevated versus continuing to trend lower. Now, one of the areas that the Federal Reserve is still very focused on is the labor market. And what we see here, it's a little bit of a messy chart, but the purple line is the employment cost index. So this can be effectively translated into what it costs employers to bring employees in, primarily based off of wages. And what we saw throughout 2021 and into 2022 was the cost to hire substantially increase. And that generates a lot of inflationary pressures within the broader market. Now, we have seen that moderate. As we can see here in this chart, in the employment cost index has come down from its peak from last year. That's something that the Federal Reserve likes to see, and they're hoping that that trend continues because it's going to be one of the primary drivers of that services inflation that we spoke about, where if consumers continue to earn above average wages, they're going to go and spend that on discretionary items, and typically that comes in the form of travel and things that aren't purchased with, things that aren't focused on just the goods side. So everyone may have bought an iPad or a laptop or a car in 2021 and 2022. You probably don't need to do the same thing again in 2023. And that's where travel tends to be one of the primary ways people are spending their excess cash. Now, the other line here is the average hourly earnings in orange, and we are also seeing that moderate as well. It's another form of wage inflation that the Federal Reserve is going to be focusing on. And so as long as we start to see these numbers come down, even despite the labor market still being very tight, as we saw with last week's jobs report, as long as the cost to employ these individuals continues to go down, that's going to relieve some stress on the overall inflationary picture. And that's where the Federal Reserve may not be as aggressive or maintain rates at such an elevated level for as long as what they're currently saying. So this is all going to be information that we keep an eye on throughout the year. It's kind of the focus on what everyone is looking at from a Federal Reserve perspective and an overall market perspective. But we just wanted to give you this little update to tell you where our thoughts were and where we think things are going to be going in 2023. As always, if you have any questions, feel free to reach out. We look forward to hearing from you. Thank you.